To understand the current trajectory of global finance, we have to look at the latest data from the European Central Bank. They track the composition of national reserves, and their recent report identifies a massive pivot in how countries are storing their bedrock wealth. This chart shows the shifting balance of global reserve assets. For the first time in decades, gold has overtaken U.S. Treasuries as the world's top reserve asset, climbing to a 27% share, while Treasuries dropped to 22%. Central banks are now collectively holding over 36,000 tons of gold. This massive accumulation approaches levels not seen since the Bretton Woods era, when the U.S. dollar was legally pegged to the metal. This data represents a historic move away from sovereign debt as the anchor of national prosperity. This behavior contradicts the traditional view held by central bankers for half a century. From a strictly commercial perspective, gold is a liability. It pays no interest, it produces no cash flow, and it carries significant costs for physical storage and security. Yet, despite those costs, these same institutions have purchased more than 1,000 tons of bullion every year for the last 3 years. Governments are bypassing digital settlement entirely, incurring massive logistical expense to fly physical bullion out of foreign vaults and bring it back home. This urgent accumulation of a non-yielding physical asset signals a collapse of confidence in the world's primary financial product, the U.S. dollar. The catalyst for this move arrived in early 2022. Following the invasion of Ukraine, Western nations froze hundreds of billions of dollars in Russian central bank reserves, effectively rewriting the rules of the international monetary system overnight. To see why this mattered, we have to look at the mechanics of fiat currency. A U.S. Treasury bond is a liability, a promise of payment that exists on a digital ledger. Its value relies entirely on the continued permission and good faith of the issuing government. This vulnerability is known as counterparty risk. If the party controlling the ledger decides to sanction you, your digital wealth ceases to exist at the push of a button. The 2022 freeze repositioned U.S. Treasuries from neutral financial instruments into active geopolitical weapons, available for use against any nation holding them. Physical gold offers a different structural profile. It is pure property, an asset that exists independently of any government's ledger, debt, or promise. It has no central bank to print it, no fiscal deficit to devalue it, and no built-in sanctions policy. For nations like China, gold is the only reserve asset that possesses zero counterparty risk. But that security comes with a single, mandatory requirement. You only eliminate the risk if you physically hold the metal within your own borders. This is why we are seeing a global wave of repatriation. Poland, for example, has been moving its bedrock wealth back to domestic vaults to ensure its national savings aren't dependent on foreign custodians. A foreign adversary cannot freeze or digitally confiscate gold that is locked inside a sovereign nation's own vault. This massive physical accumulation is no longer a defensive measure. Gold is becoming the foundation for an entirely new, parallel financial architecture. Consider the BRICS unit, a digital settlement prototype designed to bypass Western banks. To build credibility without the dollar, the unit uses a 40% gold anchor to back its reserve basket. Simultaneously, China is shifting global price discovery away from the paper contracts traded in London, moving the center of the market toward physical bullion deliveries on the Shanghai Gold Exchange. By focusing on physical metal, they expose the instability of leveraged paper products, forcing the global price to reflect actual scarcity over paper speculation. These systemic changes represent the quiet remonetization of gold by nations preparing to operate in a multipolar world. The U.S. dollar may remain the dominant medium for day-to-day global trade, but the foundation of national reserves has permanently changed. When it comes to wealth that secures national sovereignty, central banks have made a decisive shift away from paper promises and back toward physical property. In a divided global economy where trust is in short supply, the ultimate money is the one that requires no trust at all.